Hey everyone, welcome back to Corporate Decoder. Today, Idaho Copper Corporation just filed an 8K detailing a private offering, and there is one key detail about how they are raising money that I'm watching closely. Quick note, this is not financial advice, just my take on public filings for educational purposes. They just closed a private sale of convertible notes and warrants. A common way for companies to raise cash, but the specifics here offer some interesting insights into their financial strategy. This filing, called an 8K, is basically a company's way of telling the public about major events that are happening. Think of it as a real-time update on important company news that isn't already part of their regular financial reports. The big news dropped on the 17th of April 2026. This is when Idaho Copper Corporation officially closed a private offering, meaning they sold some new financial products to a select group of investors without needing to make a big public song and dance about it. The main event here is the sale of convertible promissory notes and warrants. Let's break down what that means in simple terms. These notes are like loans to the company, but with a special twist. Instead of just getting their money back plus interest, the people who bought these notes have the option to turn them into actual shares of the company's stock. This conversion is set at a price of $6 for each share of common stock. So if the company's stock price goes up significantly above $6, the note holders can convert their notes to stock and potentially make a nice profit. This is a common incentive to get investors to buy the notes. These notes are short-term, lasting only 12 months. And here is an interesting point: they do not pay any interest unless something goes wrong, like the company failing to meet its obligations. If that happens, then interest jumps to a pretty high 18% annually. This structure signals a company that might be trying to keep its immediate cash outflow as low as possible. There is also a special condition: if the company successfully lists its stock on a major exchange through a public offering, the notes will automatically convert. The conversion price at that point will be either 70% of the new stock offering price or that original $6, whichever is lower. This is designed to be a win-win for investors in that scenario. Along with the notes, investors also got warrants. Warrants are like options, giving the holder the right, but not the obligation, to buy stock at a set price in the future. These warrants can be used to buy stock for $7.5 per share, and they are valid for 5 years. This gives investors even more potential upside if the company's stock performs well over the long term. So, in this private sale, the company raised a total of about $1.36 million. This cash injection is crucial for any company, especially in the mining exploration business, which can be capital intensive. Interestingly, most investors paid cash, but two investors converted about $103,000 of existing debt they had with the company directly into these new notes and warrants. This suggests that the company might have had some prior debt holders who saw this as a better option than letting the old debt expire or trying to collect on it. The company is stating that these sales are exempt from the usual public registration requirements. This is common for private offerings made to accredited investors, meaning these are typically wealthier individuals or institutions who are assumed to understand the risks involved. To help make this deal happen, they hired a company called ThinkEquity LLC. ThinkEquity acted as the exclusive placement agent, essentially a matchmaker between the company and the investors. For their work, ThinkEquity got paid fees and, importantly, also received warrants to buy the company's stock. This is a very standard practice where the agent's compensation is tied to the success of the deal and can give them an additional incentive to ensure the offering is attractive. The filing also lists the actual documents that govern these agreements, like the form of the warrant, the form of the note, and the subscription agreement that investors signed. These are the detailed legal contracts behind the deal. And finally, the report is signed by the company's chief financial officer, Robert Scannell, confirming that the information within the filing is accurate to the best of his knowledge. This private offering is a critical move for Idaho Copper Corporation. Raising capital is always a challenge, and convertible notes offer a way to get funds now while potentially diluting existing shareholders less severely later, depending on how the stock performs. The fact that they are also offering warrants to the placement agent is standard practice, but does add to potential future dilution. Given recent news about a potential uplisting and a recent reverse stock split, this capital raise suggests they are pushing forward with their strategic plans, but the market will be watching closely to see if these funds translate into tangible progress in their exploration efforts. The key risk here is the conversion price and how it might impact existing shareholders if the stock doesn't appreciate significantly. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out the Discord in the description.